Matt has previously held senior management positions within PMI Gold, Goldfields and WMC Resources. Welcome, Mark.
Thank you, Natalia, for that introduction. It's exciting times for IGO, as we transition our organisation to be 100% aligned to battery metals or clean energy metals. It was just 2 days ago that we completed the transaction, divestment of our 30% interest in the Tropicana gold mine to Regis Resources for $903 million. And by the end of this quarter, we're aiming to complete the lithium joint venture with Tianqi, which is an investment for us about $1.8 billion. As a company, we're on the ASX 100. We have a market capitalisation about $5.7 billion, and now our business is 100% aligned to battery metals. What I'll talk to today is I'll just give you a snapshot of our strategy and then some rationale about why we're doing what we're doing, and then talk briefly a little bit about our portfolio as it exists at the moment. In terms of strategy, we want to be globally relevant supplier of products critical to clean energy metals. We'll do that with long life, high quality assets. We'll also do that by being vertically integrated with upstream metal production, but also linking that to downstream processing with ultimate end connectivity to the end user. We'll do that by producing high quality, diverse products, a diverse suite of products that's produced safely, ethically and sustainably. And ultimately, as an industry and as a business, we'll do that by being carbon neutral. Ultimately, the key driver for everything we do is our people in our organisation, which are our strength. When we talk about clean energy, we talk about that in a broad sense. We talk about that in terms of renewable energy generation. We talk about that in grid storage, and then we also talk about that in terms of electrification of transportation. As a company, we're focused on nickel, copper and lithium. The ideal strategy for us is to have diversity across those metals, and that's what we'll work towards. Why nickel? Nickel, fundamental, critical element, cathode in high energy density batteries. We're seeing continued change to high energy density batteries, more nickel in the batteries, in the cathodes. Copper required for electrification of transport, also required for the rebuilds of these grids required for renewable energy. Copper production forecast to double in demand over the next 10 to 15 years just on rebuilds of these grids to ensure that we can go decarbonised. And lithium to link between the cathode and the ion, cathode and the anode, to exchange the ions, part of battery chemistry, whether it's high energy nickel density batteries or whether it's LFP batteries. For us, we believe that nickel, copper, lithium will benefit the most from this clean energy revolution. This graph here shows Class 1 nickel supply and demand outlook. The bars show the growth and the demand that we expect to see out of Class 1 nickel. The line that you see is the production capacity. The growth that we'll see in Class 1 nickel is largely driven by EVs, which is colour-coded in the blue. It's pretty obvious to see that there is actually a gap. There will be a gap where demand will outstrip production. It's a challenge that we've had. It's a challenge that the whole industry will face as we try to bring in new production to fill that gap. It's a challenge in the nickel space especially, and largely driven by the lack of discoveries that we've seen in the nickel sulfides, and ultimately the complexity it will take to get nickel out of nickel laterites and to get nickel into battery chemicals. And that complexity is largely driven by cost and environmental considerations. When you look at lithium and you look at the demand on lithium, it's the same. The growth is huge. Again, growth is huge for lithium. By 2030, we're expecting 10 times the increase in demand for lithium. By 2030, 75% of all lithium will go into electric vehicles. That just filling that supply gap is estimated to cost around about $18 billion. So we need $18 billion of new capital invested in the industry to actually fulfil this demand requirement if we are going to be successful as part of our drive to decarbonise. As a company, our portfolio of high-quality operating and exploration assets are aligned. They're aligned to clean energy metals. We have the Nova asset, nickel, copper, cobalt, requiring interest in Greenbushes and Kwinana, which I'll talk about, and also our exploration portfolio consisting of searching for the mines of the future for both copper and nickel. When we went on this journey to be aligned to battery metals or clean energy metals about 4 years ago, we recognised the importance of what we need to do in the ESG space, in the sustainability space. I mean, we don't see that as a risk for us as an organisation. We see that as something that's right for us, right to do. As a result of that, we've developed a strong brand in ESG through the industry and leading performance and disclosures. Recognition of that is associated with even like being recognised by S&P Global for 2021. As a company, we're recognised in the top 15% of all companies disclosing sustainability reporting. We're one of 11 companies globally to be recognised in the S&P Global yearbook. Key focus for us is decarbonisation. We're committed to try to decarbonise our production. We've invested in 5 megawatt solar farm. We're looking at how we electrify our mining fleet at Nova. It's part of our journey. If you're going to be aligned to battery metals, then you also have to be aligned to how you reduce your carbon and your ESG credentials. A little bit about Nova, located 180 kilometres east of Norseman. A photo shows the asset here. For FY21, we're on track to deliver at the top end of guidance. We should be sitting around about the 29,000 tonnes of nickel, about 12,500 tonnes of copper, and around about 1,000 tonnes of cobalt. Cash costs, we've downgraded our guidance on cash costs by 29%. Cash costs in the order of $1.80 to $2.10 per pound payable. Over the last 3 quarters, we've delivered $263 million of free cash flow out of that asset alone. Just shows you the strength of that asset. This graph here shows quarter-on-quarter production out of Nova. The blue is nickel and the grey is copper. Just about 7,000 tonnes of nickel per quarter and about 3,000 tonnes of copper per quarter. The line shows cash costs continuing fall as we drive productivity, improve production at the site. Cash costs for the third quarter are sitting around about $1.83. The next stage for us is the excitement of bringing this asset into our portfolio and forming a joint venture with Tianqi Lithium. Photos here is of the Kwinana facility, lithium hydroxide facility. What you see in the photo is the completion of Train 1 in the foreground, and in the background, Train 2, which is about 30% complete. This acquisition is a fundamental transformation for IGO as we continue to lead our diversification into clean energy metals. What we're acquiring is a joint venture structure with Tianqi that will provide us with a 49% interest in the lithium hydroxide facility at Kwinana and a 25% indirect interest in the Greenbushes mine near Bridgetown. Purchase consideration is that $1.4 billion fully funded through cash flow, funded through the divestment of Tropicana and an equity raise. At the completion of the transaction, we should expect to have $300 to $500 million still on our balance sheet. So we're in a very strong financial position after the completion. 2 photos of the assets. you see Greenbushes, the world's lowest cost and highest grade hard rock lithium mine. The photo there is of the chemical grade processing facility number 2 that will get into production this year. And the other photo there is Kwinana, which is the first automated lithium hydroxide facility in the world, taking the IP with Jiangxi from China and applying that to here in Western Australia. In terms of Greenbushes lithium mine, you see the cost curve. It really defines the low end of the cost curve. That cost is largely driven by strip ratios and grade. In terms of scale, the asset has, at current run rates, about a 50-year life of mine. When we fully ramp up production, the life of the mine of the asset on reserves is around about 20 years. So reserves is about 133 million tonnes at 2.1% lithium. It really is an asset that is in a league of its own in terms of the hard rock lithium mines. Growth, significant growth opportunities, and that's what we like about the asset as well. Current capacity with CPG1, or Chemical Grade Process Facility 1 and 2, sits about the 1.2 million tonnes per annum of chemical grade concentrate. We're in the process of completing tailings retreatment project for 300,000 tonnes per annum, and there's also additional capacity to commit to CPG3 and CPG4, which takes out that total capacity to around about that 2.5 million tonnes per annum, providing that 20 years life of mine. Kwinana, lithium hydroxide plant, take the spodumene concentrate and convert that into lithium hydroxide. It's Australia's first lithium hydroxide facility. It is competitive on the cost curve. It's fully autonomous staging. Again, lying off the IP that's been developed in China, brought to Western Australia. Premium offtakes. The joint venture is really designed to provide offtake into both South Korea and Europe. It's not designed to compete with China offtake. Number of offtake partners already secured with product going into South Korea and Europe. In terms of the trains, I'll talk a little bit about in the next slide. We have there's 2 trains. Train 1 is complete construction. There's some minor construction to complete. It's around about a capital cost about $30 million to complete that. It's in a commissioning phase. We're aiming for first product by the end of this year, and then we'll go into a full ramp up that will take through 2022. Towards the back end of 22, when we take the learnings out of Train 1, we'll make a capital decision on Train 2, and then commit to that capital on Train 2, so that by the end of 2024, we should be around about that 48,000 tonnes of lithium hydroxide capacity. There's capacity on the site to have another 2 trains. That would take total capacity about 96,000 tonnes of lithium hydroxide, with all of that product coming out of Greenbushes. In terms of transaction timeline, we're aiming to complete the end of this quarter. There's 2 final hurdles that we're getting through and close to completion, which is the FIRB approval and ATO tax rulings, and we'll see that transaction complete. Another core part of IGO and a core part of our strategy is exploration. As a company, we commit to around about $60 million per annum on exploration. We've consolidated about 88,000 square kilometres of tenure on what we think is some of the most prospective belts within Australia. Fundamental to meeting this supply gap for all of these battery metals is discovery has to be part of that. Discovery of bringing in new production linked with recycling will be the solution to what we need to decarbonise society. So, in summary, completed. I mean, it's exciting that we really have completed this transformation into clean energy metals. I mean, it has been a journey for us. We had started this dialogue about 4 years ago. Really, that's been underpinned by the cash flow and success of Nova. That's enabled us as a business to do that. We've divested our 30% interest in Tropicana, which has also been able to fund part of the Tianqi Lithium acquisition, which is exciting for us. We remain committed to exploration and the discovery of the mines of the future. And as a company, we're excited about the future with a continued growth in both organic and inorganic. Thank you.